Well, good afternoon, folks. Hey, it's Shooter Scott Henderson. Of course, at the end of our presentation today, please do review our disclosures. We're going to go over swing trade notes today. Let's jump right into it. Okay, for those of you who don't know, you come to our splash page, fundamentaltrends.com. Articles are right below there. That's where they're posted and hosted. All right, so my thought for the week is, I couldn't help but think about a leaky roof because that's sort of how the week was. We had sort of a risk-off scenario. I closed my longs, et cetera, et cetera. And by the end of the week, the roof leaked, but we still were able to land on our feet. So I was able to capture the water in the bucket and not get soaked, so to speak. So now we have a number of macro drivers, Trump tariffs, both on China, Mexico, and China. CPI and PPI came in a little hotter than expected. FOMC minutes sort of a really nothing burger. But the fact is, are we going to see the brakes put on rate cut? So I think that's the big fact. And we got a clear carnival going on in crypto. I'm going to leave that alone for the moment. Let you guys review the rest of the article. Let's go over last week's P&L. Like I said, we closed out all of our long positions by the end of the week. We landed on our feet with $1 gain per contract. I'm good with that. I'll move on. All right, looking at earnings this week. Now, two of our victims, Marvel, both, earnings after the close, Broadcom, and Costco are both after the close. So let's just jump right into it. First of all, buckle up. It's going to be a volatile quarter. First, looking at Broadcom. Really, this demand zone that I have right here highlighted, I think is important. I think we get a good bounce here. I think we go at least 50% back to about 220. Now, it's not actually structured as a 50% back trade, which, by the way, I'm trying to automate these charts so it gives specific things. I want you to see where the volume shelves are, the demand zone, and I want you to see the time zone, okay? These little green, darker green lines are the monthly. These darker bands are the weekly, right? These lighter gray bands are the daily. When we have confluence of those time frames, what does that tell us? This is the most likely place for a bounce. So I would think we bounce here. If we're going to fail, this will be drive one, this is drive two, we'll get a drive three, and then we fail, right? However, I still think this holds. I think at most we're going to come back down. What do we have the difference here in price? This is one thing that is very visible in both. Notice the breadth between this low and this low. Little deeper. What is it? About 3/4 of the candle. So this low is what? Maybe a tenth of that. So I don't think we get another low. If we do, it's going to be right down here around 190.50 or 191 right there, and then we're done. Okay, so that's my thought, just looking at how the wave patterns manifest. That's my thought. All right, let's jump to the strategies. Now, the thing here is we are outlining these trades as swing trades and position, because even though some of these names, and by the way, anything I produce, I'm not watching the very short. I'm not. Because it creates a bias for me in my technical work. I'm looking for the best plays. And then that macro is something that you need to impose on how you're managing your book. I completely trust Kurt, but I trade in a different box. My structure is totally different. I'm a technical guy. If the technicals aren't there, I'm not interested. If the technicals are there, I'm interested. But it doesn't necessarily mean that the trade is strong enough to manifest into a position trade. However, if it is, and it's made it onto my list, I'm going to be watching. So this is really a structured AI growth play. There's really two, pullback entry, short-term swing. Entry zone is between 195 and 200. Targets 225 short-term to 250 for a market breakout. I don't know that we get the market breakout. Either case, we're looking at a stop loss around 190. Short-term, 210 to 230 calls, April to May expiration, and then selling cash secured puts. Makes a lot of sense. All right, let's look at our second victim, Marvel. I actually like this chart better. This, to me, is an exhaustion event. All right, so we have, now realize our confirmed lows, right, and our divergent lows. So this is a solid base, right? This is mound one. A perfect mound one. It extends down here. It's not going to invalidate the upside. That's the first thing that I need everybody to understand. It can flush. It can flush all the way down to the base of this product, down to $57. It's not going to invalidate the upside. If anything, the deeper it flushes, the higher the bounce will be. And that's the hard thing. The balance in momentum from bullish to bearish has such extremes that we can't conceptually see it until you fully understand those patterns. So I think we get a bounce here now, and I think it's about 50% back of this leg. So I'm looking for $100, right? So how do we trade that? Recovery play short term, $90 to $95 calls. Our entry is around 86 to 90 bucks, right? We're targeting short term $100 bucks. If we can continue in those trades, we're looking for 110. Stop loss around 85 bucks, right? Short term 95 to 100 calls, April to May expiry. Keep them tight. Or $85 to $80 cash secured puts. If you're really conservative, do 75s. All right. So from a position trade, accumulation between 80 and 90 is really optimal. Same 2026. You know, longer term leaps make sense here. Kirk doesn't like them. Right? Yeah, I already know he doesn't like them. However, Sentinel likes strategically. Now, I would like a deeper out of the money strike versus 110. I'd rather do 120, right? Because that's my take. That's right or wrong. I don't know if it's right or wrong. Sentinel doesn't tell me if I'm totally wrong. It argues, or he argues, or it, or what, or she, or a thing, or whatever it is. Argues its case why, and it explains why. So it likes the 110 strikes January 2026. At this point, I have no reason to doubt. So that has a little weight, and we will know the win-loss rate on that as we move forward later on to find out who was right, who was wrong. So final take, Marvel is a volatile stock. So cash secured puts are a good point of entry. All right, let's look at Costco. Now, I don't know why this chart doesn't pop out, but it's not. This is a continuation. In other words, I still like this for a breakout to all-time highs. Now, really simple. There's not a lot to do here because I did not like the price of those calls. I was, to me, it was, $1,000 a contract or $1,000 a share just screws up my math on my book and how I figure things. I can't really put an equal position size on in Marvel versus Costco because there's such a differential in price. So my risk reward is skewed. So right now, Costco, I like it for a cash secured put for a longer term position trade. Now, whether you take a conservative approach and go down to $900 cash secured puts, or you're going to sell the $1,000 cash secured put, is going to be based solely on your risk model as far as what you want to put on. That's it. That's the difference. So that's what I have for this week, folks. Great trading. Until next time.